Delayed inflation data and a divided Fed. Let's talk to Eric Diton of the Wealth Alliance for insight on both. Okay, Eric, we got a slew of economic data this week, including today's delayed PCE report from September due to the government shutdown. What among all the data that we saw this week do you think will most factor into whether or not the Fed cuts rates at its policy meeting next week?
Lots of conflicting data. I would not want to be on the Fed panel right now. I wouldn't. We had the PCE numbers, they were benign. We had initial jobless claims. They came in lower than expected, which means that's a strong economy. But we had the ADP payrolls that came in. They were down 32,000. They were supposed to be up. Earnings are coming in very strong, up looks like about 13.4%. Durable goods, strong. The leading economic index versus the coincident, that's the future versus now. It's a ratio that some people look at, is actually one of the weakest we have seen going back to the 80s. Talking about three other times that we've seen a weak number. So that means we're strong today, not strong looking forward. And that can be pre-recessionary. So if I were on the Fed and you're asking me what I would do, I would probably cut rates this month as just a preventative measure. There's enough weakness out there that I would do it. And I know this, we still don't have all the data, but we've got enough that I would not hesitate to cut another quarter.
Well, markets are still overwhelmingly pricing in that 25 basis point rate cut next week. Yet, when you listen to some Fed governors, they do seem more divided than that. So, what else is dividing this Fed?
We have a lot of uncertainty right now, much more than usual. About half of CEOs say that AI is going to increase profitability, and the other half are saying, not so sure. Are tariffs going to stand, or are they going to be illegal? And what does that mean? Well, if the money's got to be repaid, that's going to increase that deficit. And that thing just keeps rising. However, it's also going to increase profitability because these tariffs are squeezing margins. The St. Louis Fed said that the tariffs are adding about 0.5% to the PCE. They say the 2.9 would actually be about 2.49 without the tariffs. So pros and cons of the tariffs. And then there's just political pressure on the Fed, right? We know Trump is leaning on the Fed. I don't know how many times he has publicly humiliated Powell, even though I happen to think Powell generally is doing a good job. But so there's divisiveness within the Fed. There are people that are on the Trump team. There are people that are impartial. A lot of uncertainty, and it looks like the market is looking through it and feeling confident there will be the cut. I think if we don't get the cut, that could be an excuse for a pullback for sure.
Well, that leads me to my next question, which is how does this all translate for stocks? So traders are trading on Fed policy, but what about also trading on earnings, trading on AI bubble fears? What do you think?
So many conflicting factors. I will say for the month, December is generally a good month. I mean, going back to 1945, S&P's median return is about 1.5%. But in the years where the market is up over 10% and then we sell off in November, that happened 9 times, the median return is actually 3.9% with up years all 9 times. So interesting. I'm a believer in these statistics. They tend to work way more than they don't. So I'm certainly bullish for December. I'm a believer in AI. I really feel, I mean, you look at the CEO of AMD, Lisa Su, she says it's way more risky to underinvest in AI than to overinvest. Look at the Mag 7, high PE ratio, but they have grown their earnings 10 times, 20-fold at a 35% clip in the last 10 years. That's versus 8% for the rest of the S&P. And so even though they're at a much higher PE, their PE to growth rate is 1.2. The rest of the S&P is 1.7, simply because the rest of the S&P is growing a lot slower. And I don't know what inning we're in this AI cycle. It's early. It's early. So you got to be a believer, but as I always say, don't load the boat. Things can go wrong. OpenAI, which is a big push into a lot of the future revenue for a lot of firms, they're saying flat out, hey, maybe we'll start being profitable in 2030.
2030, not close. Okay, let's talk about another data point today, which is consumer spending that we got for September, part of that backlog of government data. And it seemed like momentum was stalling. We talk a lot about this K-shaped bifurcated economy with wealthier consumers propping it up. But is that sustainable? I mean, are we seeing signs at the bottom half of that K that we really should be paying closer attention to?
That's a great question and a great point. One of the recent data points was particularly interesting. Of subprime borrowers, 6.65% were at least 60 days in arrears. That is the highest number. You have to go back to about 1994 to see a number like that. I keep saying that people feel like inflation is going down. Oh, it was 9 and now it's 3. Yeah, but the 3's on top of the 9. We're not seeing deflation. Prices are not falling. The acceleration simply slowing. But if they went up 9, then they went up 4, then they went up 3, that is just increasing. And there are a whole bunch of people out there that are struggling. Now, I don't want to sound callous. They generally are not the people that drive the economy. It's the top 10% that do a lot of the consumption. But it is certainly a realistic question to ask. If this keeps happening to a greater percentage of the population, at what point does it start dripping into the rest of the economy? I mean, if half the economy suddenly is having a problem buying things, certainly retailers are going to feel that sooner or later, and that leads to banks and a whole bunch of other issues. So that risk is out there.